American Airlines is canceling flights again. But this isn't just about travel delays or passenger frustration. Behind these cancellations lies a deeper business and finance story about debt, demand, and corporate survival. In this video, Emexzel Smart Green Wealth breaks down what's really happening inside one of America's biggest airlines and why its business decisions could shape the future of air travel, jobs, and even your investment portfolio. We'll explore 1. Why American Airlines is cutting routes and what it signals for the economy. American Airlines isn't just cutting flights because of bad weather or low demand. Behind the scenes, it's a strategic retreat. The airline is trying to protect profit margins in a time of rising costs, pilot shortages, and shifting travel patterns. Post-pandemic, the travel boom is cooling. Consumers are cutting back, especially on discretionary spending like vacations. For airlines, fewer bookings mean thinner margins, and it's cheaper to cancel routes than fly half-empty planes. But here's what it really signals: a cooling U.S. economy. When airlines scale down, it often precedes a slowdown in corporate travel and tourism, two sectors closely tied to GDP growth. Airlines are like the heartbeat of the economy. If they slow, it often means the economy is losing breath. 2. How rising fuel costs and weaker demand affect profitability. For an airline, fuel is everything. Jet fuel prices have risen over 30% since early 2024, squeezing profits that were already under pressure from high labor costs. Every $1 increase in the price of jet fuel translates to millions in extra monthly costs for American Airlines. Add to that higher maintenance fees, airport charges, and debt interest from loans taken during the pandemic. Meanwhile, passengers are choosing cheaper options or not flying at all. Weaker demand plus high costs equals a profit squeeze. This is why investors are watching Americans' financial statements closely. The company's margins are shrinking, and while revenue may look stable, the cost structure is bleeding. 3. What investors, passengers, and policymakers should learn from this trend. For investors, this is a wake-up call. It shows how even large, established brands can be vulnerable when cost pressures collide with market fatigue. Airlines are cyclical, and cycles don't lie. For passengers, it means fewer options and higher ticket prices. When airlines consolidate routes, competition drops, and so does affordability. For policymakers, the trend signals a bigger issue: the economy's dependency on consumer confidence. If travel slows, tourism slows, and that ripples into retail, hospitality, and energy demand. In short, fewer flights mean fewer economic connections. 4. The big lesson: when does cost control become brand decline? Every company wants to control costs, but there's a fine line between efficiency and erosion. When American Airlines cuts routes, trims staff, or delays customer service investment, it might save money today, but risk its brand tomorrow. Passengers don't forget canceled flights or poor experiences. In business and finance, short-term survival should never erase long-term trust. For American Airlines, the real challenge isn't about saving money. It's about saving reputation, rebuilding reliability, and keeping investors confident in a turbulent market. Smart Wealth takeaway: whether you run an airline or a small business, financial discipline is good, but overcutting can ground your future. The best businesses find balance. They protect cash flow and preserve customer confidence. If you found this video useful, like, share it with someone, and subscribe for more smart and green wealth insights. Stay ahead in business plus finance knowledge.